Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Pool Lock YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. First question today is from Jim. He asks, we're 12 years away from retirement and I feel like my wife and I have done a good job of saving and investing. Do you think it's too early to make the transition to income? Jim, the good news is the two of you have a very nice gift, a reward, if you will, self-produced reward, right? The reward of having flexibility and being able to make, a decision. With 12 years to go, you have enough time to stay focused on capital appreciation and let the economy dip and let the economy recover. Other than the Great Depression, we've really never had a recession last quite 12 years, although I would say during the Great Recession, the market was underwater for about 12 years. But those are statistical anomalies, so you do have the ability to take more risk for longer if you want to because you've saved a lot. But the other side of the coin is that you don't have to. If you saved enough money and simply having that money increase at 5 or 6% a year will get you to where you want to be in retirement 12 years from now, well, then the good news is you can start making that transition right now to an income first, growth second approach. You don't have to take the risk. And at 6%, your income should double, over 12 years. So if you can average 6%, your income will double over 12 years. Think about that for a moment. If you look at what your income could be generating today from your investments and double that figure and say, gosh, that's enough for me, well, then you've got the luxury of having a choice to be able to make a decision. And again, it depends upon your risk tolerance and temperament. If you're aggressive by nature, stay put. You've got time on your side and the potential for greater returns. But if you're more conservative, you can make that transition early and sit back with peace of mind. Now, this approach has a significant advantage if the economy does turn sideways at some point and you are one of those people that gets laid off when you're in that kind of red zone coming into retirement. And unfortunately, we see this happen to folks in their 50s and early 60s. Then you'll be set to go. There won't be a lot of transitioning that is necessary to make because you'll already have that income stream established and working for you. But here's the other thing that I want to tell you, and this is really simple. It's not a switch, it's a thermostat. You can start making the transition to an income first, growth second approach gradually over time. It's far from an all or nothing proposition. You might start by transitioning 20 or 30% of your portfolio toward dividend-paying stocks, REITs, or bond ladders, while keeping the remainder focused on growth. Then, over the next few years, you can continue to adjust that allocation as you get closer to retirement and as your comfort level with income-generating investments grows. The beauty of starting this transition now is that you have time to learn how these income investments behave in different market conditions. You can see how dividend yields fluctuate, understand the tax implications, and get comfortable with the cash flow patterns. This knowledge will serve you incredibly well when you do reach full retirement and need to rely more heavily on that income stream. Great question. Great first question. As always, if you'd like to send in your question, you can do so. You can email them to poollock@poollock.com. Let's get to our second question. And this is from Alice. And she says, we've been retired about 5 years, drawing 4% or so annually from our accounts. They're still going up. So what's the issue? Well, the issue is you got lucky, right? I can't say it any other way. The markets, they've gone up. So if you've been in a more growth first, income second approach, then you've been okay with drawing that 4% per year. So if you have $1 million and you were drawing 40,000 a year, and maybe 5 years later, your account is worth 1.1 million or 1.2 million, you can get lucky and it can work. But eventually your luck is likely to run out. If you've retired at a reasonable age and you've been retired for 5 years, you're probably in your 60s, maybe 70 at the oldest. And there's a 50% chance, 50, that you and your husband, one of you will live another 22 years. That's not me saying it. That is, if a life insurance actuary were talking to you, he'd say, there's a 50% chance one of you is going to make it 22 years. So you have to think, what are the chances in the next 22 years that the stock market has a major drop? And now we start to aggressively cannibalize our principal. And my best crystal ball guess would be the chances are pretty high that that happens at some point in the next 22 years. Now, if you're starting with more money, you can argue that, well, hey, I can get ahead of it, right? Even if it dips, it's dipping from a higher dollar amount, granted. But remember that as the market dips, you're cannibalizing, you're selling more shares because the price per share is lower. This is what we call sequence of returns risk, and it's the silent killer of retirement portfolios. God forbid, if we have anything else that resembles, when the tech bubble burst, the market was underwater for 7 years, or the financial crisis hit and the market was underwater for 6 years, right? Now there's still a chance you could run out of money. Think about this scenario. If you had retired right before the year 2000, you would have experienced not one, but 2 major market crashes in your first decade of retirement. The tech crash from 2000 to 2002, then the financial crisis from 2007 to 2009. Imagine trying to maintain that 4% withdrawal rate while watching your portfolio get hammered twice in 10 years. Many retirees in that situation had to make some very difficult choices about their lifestyle and spending. The mathematical reality is harsh. When you're withdrawing money during a market decline, you're locking in those losses permanently. Those shares you sell at depressed prices can never participate in the eventual recovery. This is a fundamentally different, it's significantly different from when you were accumulating wealth and could just ride out the storm. So I would kind of reverse the question. I would say, why take the risk? If you can withdraw 4% and that works, then why not invest for a 5 or 6% income stream with an income first, capital appreciation second approach? Then you get more income than you need. You can reinvest the rest if you want to grow your money the old-fashioned way through reinvested interest and dividends, or you can just go ahead and spend more money and live maybe even a better lifestyle with less stress and less worry than you're having currently. Here's what I mean by that income first approach. Focus on dividend-paying stocks, REITs, corporate bonds, municipal bonds, if you're in a higher tax bracket. Maybe some preferred stocks. Build a portfolio that can generate 5 or 6% yield from actual cash payments, not from selling appreciated assets. That way, whether the market goes up, down, or sideways, you're still getting your income. And if the market does well, that's just a bonus on top of your reliable income stream. So I encourage you to please consider that with your husband. You've done well so far, but don't let recent success fool you into thinking the next 20 years will be just as kind to you as perhaps the last 20 were. Thanks for a great question. If you would like to send in your question, you can do so by emailing them to poollock@poollock.com. If you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank,